Doing a Roth conversion could be an excellent way to shield your retirement savings from higher taxes down the road, but there are a number of taxes and costs that you could end up paying in the short term. In today's video, we'll evaluate every possible tax or cost that may result from a Roth conversion and ultimately decide if all this extra expense is worth it. The first tax you'll have to pay when executing a Roth conversion is federal income tax. Whatever portion of your IRA you convert to Roth is realized as ordinary income and piled right on top of all your other income. Here's an example. Let's say you're married and filing jointly. Your taxable income is $100,000 and you convert $100,000 to Roth. That means you'll owe 22% on $100,000 or $22,000 in federal tax. Remember, you shouldn't convert to Roth unless you think that your federal tax rate in retirement is likely to be higher than it is today. The second tax you could end up paying when doing a Roth conversion is state tax. If you live in Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, or Wyoming, you won't have to pay state tax, including on Roth conversions. If you live in Illinois, Iowa, Mississippi, or Pennsylvania, you do pay state tax, but Roth conversions are exempted. Should you move to one of these states to avoid paying taxes on Roth conversions or other retirement distributions? Probably not. Remember, while these states may not charge income tax on Roth conversions, they do make up for it in other ways, like sales and property tax. The third increased cost you could end up paying when doing a Roth conversion is IRMA. First, let's define the acronym IRMA. That stands for Income Related Monthly Adjustment Amount. This is an additional charge you could be required to pay on your Medicare Part B and D premiums. The following chart demonstrates how, as your income goes up in retirement, your Medicare Part B premium goes up right along with it. By the way, the standard deduction does not apply when calculating IRMA. Here's an example of how much extra you could end up paying. Let's say that you and your spouse file a joint return and have $106,000 of taxable income. Let's also say that you do a Roth conversion of $100,000. That would bump you from the lowest Medicare Part B premium threshold to the second lowest. Instead of you and your spouse paying $174.70 each per month, you'd now be paying $244.60 each per month. That would cost your household an extra $1,677.60 per year for having done a Roth conversion. By the way, you could do a Roth conversion prior to ever getting on Medicare and still end up paying that increased premium. Here's why. The IRS has a 2-year look-back period when it comes to the IRMA calculation. So if you did a Roth conversion at age 63, for example, that would be included in the IRMA income calculation at age 65 when you finally do get on Medicare. The fourth tax you could pay as a result of doing a Roth conversion is Social Security taxation. To understand how Social Security taxation works, you have to first understand provisional income. This is the income the IRS tracks to determine if they are going to tax your Social Security. What counts as provisional income? Among other things, any 1099s coming from your taxable investments, any distributions coming from your retirement accounts, including Roth conversions, and 1/2 of your Social Security count as provisional income. So the IRS adds all this provisional income up, and if as a single person it adds up to more than $34,000, or if as a married couple it adds up to more than $44,000, then guess what? Up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. The fifth tax you could pay as a result of doing a Roth conversion is net investment income tax, or NIIT. This is also commonly referred to as the Obamacare surtax. Here's how it works. NIIT is a 3.8% surtax on the lesser of your net investment income or the amount your modified adjusted gross income exceeds the threshold, which for single filers is $200,000 and for married filing jointly is $250,000. Net investment income includes interest, dividends, capital gains, rental income, and passive business income, not Roth conversions or IRA distributions. However, even though the Roth conversion isn't itself subject to NIIT, it can push your modified adjusted gross income over the NIIT threshold, which could cause other investment income to be subject to NIIT that otherwise wouldn't be, or increase the amount of your investment income that is subject to the 3.8% surtax. Here's an example to show how it works. Let's say you're married filing jointly and have $100,000 of modified adjusted gross income without the Roth conversion, but $250,000 of modified adjusted gross income when you include your Roth conversion. Let's also say you have net income of $20,000. Because of your Roth conversion, you are now $20,000 over the $250,000 NIIT threshold for married filing jointly, which means you would now owe 3.8% on $20,000, which is $700. $760. The sixth tax you could potentially pay as a result of doing a Roth conversion is an indirect one and results from the phase out of certain credits or deductions. These credits and deductions include the child tax credit, the student loan interest deduction, the saver's credit, and education credits. The seventh tax you could potentially pay by doing a Roth conversion comes in the form of underpayment penalties. Here's why. A lot of people will wait until the fourth quarter before they do a Roth conversion. They do this because they typically have a better idea of their income by that point in the year and better understand the tax implications of the conversion. Many people will also choose to pay the taxes on that Roth conversion with cash instead of simply having the taxes withheld by the IRS. Why? Because it's mathematically the right thing to do. By getting 100% of those converted dollars into your tax-free account, your money lasts longer. When you pay the taxes on your Roth conversion out of cash in the fourth quarter, however, the IRS expects you to have paid taxes on that Roth conversion evenly throughout the year. And if you didn't pay quarterly taxes on that income evenly throughout the year, the IRS can charge you an under withholding penalty. The final tax you could end up paying as a result of doing a Roth conversion applies to those who are getting health insurance through the Affordable Care Act. If your Roth conversion pushes you above subsidy thresholds, you could have a partial or total loss of subsidies or possibly have to repay subsidies at tax time. In summary, the increase in your modified adjusted gross income that results from doing a Roth conversion may cause you to pay taxes or increase costs such as federal income tax, Medicare IRMA, NIIT, Social Security taxation, state income tax, tax credit phase-outs, underpayment penalties, and ACA subsidy loss. All of this begs the question as to whether doing a Roth conversion is really worth it. If you face the prospect of paying all of these additional taxes and costs, does a Roth conversion still make mathematical sense? The answer is, in many cases, yes. Here's the thing, you have to think of all these additional taxes or costs as trade-offs, not problems or unintended consequences. For example, you may pay increased Social Security taxation during the period of your Roth conversion, but then eliminate Social Security taxation altogether by the time your conversion is complete. Next, a conversion may increase your federal income tax bill in the short term, but it may insulate you from a dramatic increase in taxes over time. Consider this. If Trump extends his tax cuts, and there's every indication that he will, then the national debt will grow to $62 trillion by 2035. Most experts believe that the only way we can service this massive debt load is to dramatically increase income tax rates. In fact, a recent Penn Wharton study said if we don't right our fiscal ship of state by 2040, then no combination of raising taxes or reducing spending will prevent the financial collapse of our nation. Roth conversions may also cause you to pay increased IRMA in the short term, but by reducing or eliminating your RMDs in retirement, you could dramatically decrease your Medicare Part B and D premiums over time. In general, Roth conversions do cause you to pay additional taxes and expenses in the short term, but they dramatically reduce those costs over the balance of your life once your conversion is complete. So does it make sense to do a Roth conversion notwithstanding all the potential taxes and costs? It does take some number crunching to figure it out, but in many cases the answer is a resounding yes. I'm David McKnight. Thanks for watching.